Good morning, friends. Hope you're all doing great. Today, we shall continue with the matters of unincorporated traders. Today, we shall primarily be looking at what happens in case of partnerships. Now, the most examined questions in case of partnerships is that what happens to the allocation of profits when a partner joins a firm or when a partner leaves a firm. So, we will be looking at all of these topics and basically what are the rules regarding partnerships for division of profits, for allocation of profits for unincorporated traders. So now without wasting any time, let's hit the topic of partnerships. Now partnership basically, like I said, is basically when two or more partners come together and they start a business. When now the partners are there, definitely there would be a profit sharing ratio amongst the partners, which basically means the ratio amongst which the profits of the firm would be divided amongst the partners. So let's have a look at what are the rules with respect to partners and with respect to partnerships. So now, although a person may be a partner, just grab my pen, right? Although a person may be a partner, maybe a partner in a firm, he is still what? He is definitely in himself a separate taxable purpose for income tax purpose. So what is he in himself? He is a separate entity in himself, right? What about partners? Partners share of the partnership profits is assessed to tax as part of his total taxable income for the tax year, which basically means whatever is the partner's share of the profits gets added as his own personal income under income tax computation. So that is basically a part of his computation. That is basically a part of his income upon which he is going to pay income tax. What about for self-assessment purposes? What is the firm going to do? The firm is going to produce a partnership return showing the allocated amounts of income of all the partners. Now, each partner is going to use this information to complete what? To complete his individual tax returns. So, basically, the partnership return, that is the return of the partnership, the firm itself, is used as the basis for by the partners in determining their own income tax liability. So now let's have a look at what are the rules with respect to allocation of trading profits and losses between the partners in a partnership firm. When I'm talking about profits and losses, like I said, definitely they get split amongst a profit sharing ratio which is decided upon at the time of admission of a particular partner itself. So at the onset itself, we know what each partner is entitled to receive or not to receive. So adjusted profits and losses determined for the period of account of the firm as a whole are allocated between the partners in the profit sharing arrangements of that period of accounts. Now, this profit sharing ratio can be any arbitrary percentage. It can be 50-50, 40-60, 30-30, 20, whatever gets decided amongst the partners when they are basically joining the business itself. Now, profit sharing arrangement is equals to what? It is equals to the partners' salaries plus the interest on contributions to the firm's capital plus the profit sharing ratio that is used to allocate the surplus profit. So all of these together basically comprise the profit sharing arrangements. These are the various components of the profits that they could be divided amongst the partners. What else? What about allocation? What about in the period of a profit sharing arrangement changes during the period of account? So what happens when this particular ratio which was decided at the onset has now subsequently changed during the period of account itself? Definitely what we need to do, we need to time apportion the profits according to the particular profit sharing ratio to which it is allocated. So the profit sharing arrangement changes during a period of account. The profit or the loss is time apportioned between the periods before and after the change. So basically what you need to do, supposingly there has been a change, what you need to do, you need to time apportion before change and after change. So whatever be the apportionment of profits, whatever be the said profit sharing ratio before, you need to allocate it accordingly, and after the change, you need to allocate it accordingly. If partner's share of profit of losses is used to determine his assessment under the current year basis for each tax year, that is, for income tax purposes, whatever is the net profit received by each partner would then be subject to income tax under their own income tax returns. Let's now have a look at a few examples and better understand all of these basic rules of partnership which we have done till now. So let's have a look at a few examples to start off with. Right, so what do we have here? Jekyll and Hyde started a professional practice on the 1st of January 2013, preparing annual accounts to 31st of December. Their initial profit arrangements were salaries 30,000, 40,000 Hyde, 10% interest on capital account balances, capital account balances being 200,000 and 150,000 pounds. Profit sharing ratio is 60-40. Adjusted trading profits for the year ended 31st of December were 140,000 pounds. So what we've been given? We've been given an adjusted profits, we've been given profit sharing ratio, we've been given salaries, we've been given 10% interest on capital as well. So now let's have a look at allocating all of these amongst the two partners, Jekyll and Hyde. So let's have a look at the year ending 31st December 2014. We got two partners. We got first a total column to prepare, and then we can allocate it amongst the two partners, Jekyll and Hyde. Right. So what do we have in total? We got adjusted profits. The total has been given to us. Adjusted profits total is 140,000 pounds, which we now need to divide amongst. First we give what? First we need to give salaries to the partners. So salaries of Jekyll is 30,000. Hyde is 40,000, totaling how much? Total equals to 30,000 plus 40,000 equals to 70,000. Salaries have been given away. Up next, we need to give interest on capital. Which is 10% is given, which equals to 10% of 200,000, which is equals to 20,000 pounds, and 10% of capital here is 150,000 pounds. So 15,000. Now totaling to 20,000 plus 15,000, 35,000. Now out of your total of 140,000 pounds, how much is left to be allocated as profits? Let's have a look at. Another 35,000 pounds is left to be allocated as profits in the profit sharing ratio, which is what? Which is 60-40. So let's divide this 35,000 pounds in the 60-40 ratio, which has been told to us. So 21,000 pounds go here, and what is this? 35,000 multiplied by 40% goes here. So this is the allocation amongst the two partners. Thus the total profit share is equals to how much? Is equals to 70,000 plus 35 plus, sorry, let me just put another plus here, plus 140,000 pounds. Similarly, let's find it out for the two partners that we have. So it's going to be what? Some error in formula. Right. So 71,000 pounds and 69,000 pounds is what gets allocated amongst the two partners, Jekyll and Hyde. So nice and easy example. Let me quickly run through the rules with you. What basically we start off with the adjusted profits. We first give away salaries. Thereupon we give away the interest on capital. Whatever is the balance outstanding gets divided amongst the partners in their profit sharing ratio. So very simply, all you need to do is start off with your total adjusted profits. First, give away salaries, thereupon give away your interest on capital, and the remaining gets divided in their profit sharing ratio. Now let's take it a little forward. Let's have a look at another example. Facts as an example one, accept that profit sharing arrangements on the 1st of April 2015 is changed to as follows. So the salaries are 50/70. Interest on capital has been told to us in example 1 already. And the profit sharing ratio from the 1st of April is now 55 and 45 instead of the previous 60/40. Adjusted trading profits for the year ended 31st of December is 180,000 pounds. Now that we know this, that there has been a change in the profit sharing ratio, what does our rule say? The rule says that divide this profit sharing ratio in the, and the allocation needs to be done time apportioned accordingly before and after your profit sharing ratio gets divided amongst the two. So what do we have? Let's have a look at the year ended 31st of December 2015. How much do we have? We need to divide it amongst the two. What the total adjusted profits that we have? The total adjusted profits is 180,000 pounds, which needs to be divided amongst Jekyll and Hyde. Right? So let's start. We've got two time frames here, before the 1st of April 2015 and after the 1st of April 2015. So what happens before the 1st of April 2015? When did this year start? Started off on the 31st, on the 1st of January. So January, February, March, 3 months the profit sharing ratio becomes what? Remains 60/40. Thereafter changes to 55 and 45%. So what do we need to do? Before 31st of, before the 1st of April 2015, that is a period of 3 months. What happens? Everything gets time apportioned for 3 months. How much are the salaries to start off with? Salaries in the first part were how much? It was 30,000 for the entire year and 40,000 for the entire year for Hyde. So we need to time apportion it accordingly. So it becomes how much? It becomes 30,000 equals to, okay, so salaries here are given to be 50,000 pounds. However, this is for the entire year. You need to take only for 3 months. So becomes this much. Salary here is 70,000 pounds for the entire year. You need to time apportion it accordingly. 3 divided by 12 comes out to be a total of how much? Total is 125 plus, so total 30,000 pounds. What about interest on capital? Remains, it is as per what was given to us previously, which is 10% of your capital is 200,000, so which means 200,000 pounds multiplied by 10%. Again, you need to time apportion the same. 3 by 12 comes out to be 5,000. Similarly, interest is 150,000 pounds here. Multiply it by 10%. Time apportion it for 3 by 12. Up next, what do we have? Now the remaining is profit sharing ratio. So let's split this profit sharing ratio. Now remember, your profits are divided once the entire salaries and the entire interest on capital have already been given away. So what we need to do is we need to leave this blank as of now. Let me just total this as well. We leave it blank as of now and we do it after the 1st of April 2015. How much salaries do we have? Salaries are now the remaining. Jekyll gets remaining £50,000 for the 9 months ending the 31st of December 2015. Thereafter, what do we have for Hyde? The salary is £70,000 multiply by 9 divide by 12. What next? Let's have a look at interest on capital, which is 10%. 10% of capital is £200,000 multiply by 9 divide by 12. Similarly, here is how much? 10% of how much is capital? It's £150,000 multiply by 9 divide by 12. Right? So let's total these. Similarly, let's total this as well. Right. So how much do we have out of the total profits? Now we need to divide profit sharing ratio, which gets divided by what? How much is balance profit left? Let's have a look at. We had a total of 180,000 profits minus how much we've already given away as salaries in the first 3 months, £30,000 minus we've given away interest in the first 3 months minus we've given away salaries for the next 9 months minus we've given away interest for the next 9 months. Total 25,000 profits is left, which now needs to be divided amongst this profit sharing ratio of how much? We are going to divide this £25,000 in their respective profit sharing ratio, which is 60-40 here for how many months? For 3 months here. Similarly, £25,000, 40% here, and for 3 months here. Similarly, we have what? We got £25,000 now to be split in this changed ratio of 55-45. So 55% here multiply by for the 9 months ending the 31st of December. Similarly, what do we have here? We now got £25,000 to be split in 55-45 percentage for 9 months period. Right. So how much total do we have? Let's sum these up. Let's see if we have been able to bifurcate the entire profits of £180,000. Salary, interest on capital, profit sharing ratio, salary, interest on capital, profit sharing ratio. So the entire £180,000 have been split accordingly. So very simply, what we need to do is that when there is a change in the profit sharing ratio, you need to do what? You need to time apportion what? You need to time a portion before the change and after the change. The ratio which was before the change and the ratio which was after the change. The rule still remains the same. What we do, we first give away salaries. We give away interest on capital, so salaries and then interest on capital. And on the remaining profits, we split the remaining profits in the profit sharing ratio and we time apportion them accordingly. Let's have a look at another example. What happens here? Facts as in example 1 and 2. Now we are supposed to do what? We are now supposed to calculate the trading income assessment for both the partners for the relevant tax years. So let's have a look at what are the relevant tax years to begin with. We've started to trade, right? So what is our relevant tax year? 1st of January. The tax year is what? The tax year, let me just grab my, right. So the first tax year, opening tax year. Let me just go back to the question. When you just started to trade, you started to trade on the 1st of January 2013. So the first tax year is 1314. So what do you take? Opening tax year is 1314. You start from the date of commencement of business. So from the 1st of January 2013 and go up till the 5th of April. 5th of April 2013, which basically means you're going to tax how many months? 3 months profits out of the allocated profits. Let's have a look at how much profits did we allocate here. The first year profits were £71,000 and £69,000 for hide. So what do we have? Out of this £79,000, 3 months profits get allocated. Let me just write down the names. Jekyll, and we got Hyde. So what happens here? Profits, so the first 3 months gets allocated, which comes out to be, this was 71,000, only need to take 3 months profit out of the total 12 months profit given to us. Similarly, here it was £69,000, you need to take 3 months profit out of the total profits given to us. Now what happens the next year, which is 1415? You ask yourself a few set of questions. First, make your timeline. So this, what happens here? From the 6th of April 2014 up till the 5th of April 2015. Let me just make it here so that the answer becomes tidy. Right, let me just write it here. So from the 6th of April 2014 up till the 5th of April 2015, you ask yourself a few questions. Is there an accounting period end which ends this tax year? Is there one? Yes, there is. When does it end? It basically ends. It ends the 31st of December 2014. So is this period? So this is yes. Is this period 12 months old? Yes, it is. What do? You tax those 12 months profit. So how much is the 12-month profit? Gets back to example 1. 12 months profit is £71,000 and £69,000. So what do we have? We have the total £71,000 here and £69,000 here. You've now arrived at a current year basis, thereby now what this has resulted in? It has resulted in an overlap profits of how much? Overlap profits of 7. This is overlap profits here. This is the entire overlap profits here and this is the entire overlap profits here. So this is overlap profits. This is overlap profits. Now what do? In 15-16, you've already arrived at the current year basis. So you tax the entire 15-16 profits, which was how much? Which was a total of, let me just do the totals here. In this question, I did not do the totals. Right. So I now have my totals. These are the amount of totals that I'm going to tax in my 15-16 profits, which gets taxed in the hands of the Jekyll and Hyde individually as individuals, right? So how much it is? The entire amount gets taxed here. Similarly here, you've already arrived at current year basis, so you need not ask yourself the same set of questions again. Why? Because you've already arrived at the current year basis. So very simply, just follow the simple rules and you will be able to sail through the answers. What next? Let's get back to the rules now. Right, so let me open my PPT again. What happens when there is an admission or retirement of partners? Extremely important. This is what gets taxed. This is what gets examined most of the times in your examination. So make sure you are well versed with what happens when there is a new partner coming into the business or when a particular partner ceases to act as a partner in the partnership firm. So know the rules of admission as well as retirement of the partner. So what happens upon admission? Let me grab my pen. When a partner is admitted to an existing firm or a sole trader takes on his first partner, the incoming partner is assessed using the current year opening year rules on his share of the firm's profits. The assessment of each of the existing partner remains unaffected. Why? Because it's a new partner that has come in. So for that particular new partner, what it is? It is a new year. So you're going to follow the opening year rules. But remember, only just for the partner which has just joined in, only for the new incoming partner. What happens upon retirement? When a partner leaves his existing firm, the last year basis applies to his share of profits only, with relief for his share of accumulated overlap profits taken at the time of retirement, at the time of ceasing to act as a partner. Again, the assessment basis for all the remaining partner remains unaffected. So very simply, what do we have here? The rules remain the same. Let me just grab a new pen. Right. So what basically happens for a new partner? We are going to follow the opening year rules. And for the partner who is retiring, we are going to follow the last year basis for this retiring partner, which basically means for the opening year overlap profits that he had paid tax upon twice, now he can claim a relief in the last year of trading as a acting to act as a partner. Basically, which means that what are you doing? Supposingly there are three partners. There were two partners, A and B, and now a third partner, C, has joined in business. It's a new partner, right? Because they were existing partners, everything else remains the same for them. However, because C is a new partner, in the first year of the income, you are going to treat this income as an opening year rule under the trading income assessment rules. Similarly, what happens when one of these partners retire? Let's have a look at what happens when any of these partners retire. Let me just open up another page for myself. Right. Supposedly there were three partners, A, B, and C. C has now retired. Because C has now retired, it's the last year as a partner for him. Because it's the last year as a partner for him, you can use the last year basis and avail relief for overlap profits upon which he had paid tax twice. What about A and B? They are still the existing partners. On the existing partners, what happens? Everything else remains the same. So there is no change for them. The only change is for the partner who is retiring, ceasing to act as a partner. He can now avail his, he can now take relief for the overlap profits upon which he had paid tax twice. Now, instead of just one or two partners ceasing to act as partners, what happens if the entire business, the entire partnership is ceasing to trade? So, what happens in case of cessation of the firm as a whole? So, when the entire partnership in the entire firm ceases to operate, business ceases partnership, the last year basis is now going to apply for all the partners with relief given for each partner's share of accumulated overlap profits. Why? Because the firm itself is now ceasing to trade business. So basically, it becomes the last year of trade for all the partners. Thus, they take what? They take relief for opening year overlap profits in the last year of business itself. For all the partners, we are going to follow the last year basis. Let's understand this with the help of an example. Let me just open up a quick example for you. Right. Parker started trading on the 1st of January 2012. On 1st of January 2013, he admitted two of his managers, Penn and Quill, as partners. So what is happening? Basically, two of the managers, Penn and Quill, get admitted as partners of the firm. On 30th of June 2014, Penn resigned, and on 31st of December 2015, Parker and Quill dissolved the firm and ceased trading. So a lot is happening. First, Parker comes in, after which Penn and Quill join in, after which Penn retires, and after which the partnership firm itself dissolves. Right? So there's quite a lot of things happening in this question. We'll see what happens for each one of them sequentially one by one. Accounts are prepared to 31st of December annually. Adjusted trading profits for the relevant accounting periods were year ended 31st of December 2012, profits are £80,000. 31st of December 2013, profits are £200,000. 31st December 2014, profits are £250,000. 31st December 2015, profits are £180,000. Profits of the partnerships were shared as follows. 1st of January 2013 to 30th of June 2014. Salaries per year is given for the three partners. Interest on 6% a year on fixed capital is also given. So is given their profit sharing ratio. From the 1st of July 2014 to the 31st of December 2015, the partnership sharing ratio has now changed. Salaries per year is 60 each for each of these partners. Interest on capital remains the same. Profit balance in profit sharing ratio is now 50-50. Let's have a look at the question. What else? Required, show the allocation of profits between the partners for all the periods of accounts and calculate the trading income assessment for each of the partners for the relevant tax year. So very simply what we need to do is first calculate the allocations for each of these partners as partners, and then as individuals we need to take their income and find out their trading income assessment. So without wasting any time, let's start with what happens in the question. First, you've started to trade when? In the year ended 2000. In the year ended 2012. So in the first year, what has happened basically? Let me just write it down here itself. Let me just grab my pen again. Let me write it here itself simultaneous to the question. So you're all able to see that basically what is happening where. Right. So the first year of trade, who do we have? We only have Parker who has started to trade business. So year ending 31st of December 2012, we only have got one partner. Let's make a total column. And how much do we have? We only have one partner who is Parker. So the entire things get profit of the entire 80,000 pounds gets allocated to Parker himself. Why? Because there is nobody else who yet has joined the business. Up next, in the next year, that is year ended 31st of December 2013, what has happened basically? Now we have two more partners. So let's make columns for these partners. Who's joined in? Parker is already there. We have got Pen and we've got Pen and Quill who have joined this business. When these two come in, what do we have? We got from the 1st of January, what happens? In the middle of, in this year, what remains? Salaries of 50, 40, 40 is given. So this year, the entire year till the year ended 31st of December 2013, this is the profit sharing ratio which has been given to us. And we already know that how we have to calculate it. So first we give what? What is the total profits? Let me just make a total column first. Total profit is how much? Total profit is 200,000 pounds of profit has been earned, which I now need to divide. So first I give what? First I give away salaries. Salaries of how much is given away? Salary per annum is 50,000 for Parker, 40,000 for Pen and 40,000 for Quill. What about interest on? So total salary, how much is given? Total salary given is 130,000 pounds. Next, what do we have? We got interest on capital, which also has been told to us as what? As 6% on fixed capital, 6% of, let me bifurcate it amongst the three partners, 6% of 100 and how much it is? Let me just bring it down here itself. 6% of 100,000 pounds. Similarly, we have 6% of what is the capital here? Capital is 60,000 here and we have 6% of capital which is 3,600 here. So how much it is? Let's find out the total. So out of the total profit, how much is remaining to be bifurcated as profits? Out of the total 200,000 pounds, we now have 56,800 to be divided amongst as in the profit sharing ratio, which is what? Profit sharing ratio is 50%, 25% and 25%. So let's just divide this 56,800 pounds into 50%. Do we have here? Yes, 50%. We got 25% and we also got another 25% here, right? So what do we have? Let's sum up the income for each of these partners for the entire year ended 31st of December 2013, which comes out to be, right, Now what do we have in the year ended? Let's go next year. Year ended 31st of December 2014. In the middle of this year, what has happened? There has been a change. Why? Because there has been a change. Because one of the partners has retired, thus there is a change in the profit sharing ratio. So the total profit is how much? So total profit of this year is 250,000 pounds, which needs to be divided in their pre-change period and their post-change period. So for the first 6 months to how much? To 30th of June. How much do we have? Salaries are going to be salaries come out to be how much is the salary? 130,000 pound is the salary for the total year salary is how much? Total year salary is 50,000 pounds. However, we need to take only 6 months of this. So comes out to be 25,000 pounds. The entire year salary is 40,000 pounds. We need to take 6 months out of these. Similarly, we have 40,000 pounds for the entire year. Take 6 months salary out of these. So what next? Let's have next. Up next, we have interest on capital. Interest on capital is how much is the interest on capital? 6%. So which comes out to be 6% of capital is given to be right. Formula cut loss is equals to 6% of 100,000 pounds, but only for a period of 6 months. Similarly, we have 6% on the capital, which is on the capital, which is 60,000 pounds here, and we have 6%. Up next, what do we have? We have a salary. We have a profit sharing ratio. Which will be divided after the end of the year. So leave it blank as of now. So next 6 months to 31st of December 2014. How much salaries do we have? The salaries that we have now is given to be, it's 60 for the entire year. So we only have to take 6 months as of now. So it is equals to 60,000 multiply by 6 divide by 12. Similarly, we have 60,000 multiply by 6 divide by 12 here, right? Up next, we what have? We have interest on capital, which is equals to how much? Interest on capital, total capital given to us is 6% of capital is the same 100,000 pounds taken for a period of 6 months. Similarly, we have 6% taken for a period of 6 months. Right? What next? We also now have, let's now have a balance as to what is left. This, let me just sum up. To find out how much is left. So there's an error in the formula. Is equals to this plus this plus this. 65,000 pounds here. Let's sum up and find out what of the profit is left. How much profit is left? This is profit sharing ratio. What is left out of the total profits of 250,000 pounds for the entire year? You've given away salaries, you've given away interest on capital, you've given away, right? So what is left? We got 100 and let's have a look at what is left. Out of the total 250,000 pounds, we've given away 65,000 pounds, we've given away 10,200 pounds. There seems to be an error here. Let me just check. Did I multiply it by 6 months? No, I did not, right? So I need to multiply this by 6 months. Similarly, I need to multiply this by period of 6 months. Now, how much do I have left? There is also, I've also done this, is done 60,000, 4,800, right? So how much is left? Out of my profit, 65,000, 6,660 and 48. I now have a balance of, let me see how much balance is left, 100 and, I've taken away everything. Yes, I have. So this now needs to be divided in the profit sharing ratio, which is how much? This is equals to 113600 multiply by the profit sharing ratio was 50, 25 and 25. So 50%, however, only for a period of 6 months. Similarly, this comes out to be 113600 multiply by 25% for a period of 6 months. So 6 divided by 12. Similarly, here it comes out to be 113600 multiply by 25% multiply by 6 by 12. So now what do we have here? We have the remaining profits. The remaining profit is how much? 113600 gets divided in the ratio of 50-50% now. This I need to, sorry, further bifurcate, right? Have I done it right? I hope so. 6 by 12. Oh, not here. Should be here. Right. So how much do I have? 113600 gets divided 50-50% now for a period of 6 months. Similarly, 113600 multiply by 50% multiply by 6 divided by 12. So this is what I now have left. Let me see if I've been able to bifurcate my total profits. £250,000 in the ratio which it was supposed to be split under. Now that I've done this, let's find out what gets bifurcated amongst these partners individually for the entire year. Right. Oops. What did I do? Right. So for all the three partners, I have been able to bifurcate the profits of £250,000. First, given away salary, given away interest on capital. The remaining gets divided in the profit sharing ratio as it remains for whatever time frame applicable. What next? Let's get back to the question. What happens the next year? We do have year ended 31st of December 2015. What happens in this year? First, we give away salaries. The total profits are how much? Total profits are given to be 180,000 pounds. So we first give away salaries. Salaries as in the ratio given, which is 50% given. Salaries is 60 and 60 now. So we give away salaries of 60,000 and 60,000 amongst the remaining two partners. Comes out to be 60 plus 60, 120,000. You up next give away what? You give away interest on capital, which is 6% of your total is 100,000 pounds, so 6,000. Also you have 6% here, making a total of, up next you're going to give away profit sharing ratio, which is what now? Which is 50%. How much profit is left? Let me just find out. Minus salary minus interest on capital. So 50,400 gets divided amongst the partners as 50%. Right? So what do we have? What have I done? Excel is fooling around with me. We have 50,400 multiplied by 50%. Thus totaling salary, interest on capital, profit sharing ratio. So how much do we have total here? This is what we have total here as well. Now can we find out? Part A is done. What did it ask us? Show the allocation of profits between the partners for all the periods of accounts. We've been able to total how much is the period of account, how much is the profits earned by these partners in all the periods of accounts. So first year, this is the total. Second year, we have this as the total. Up next, we have in the next year, we have this as the grand total. And the next year onwards, what is this? Let me just get back to the question. Right, let me grab my pen. Last year, we have this as our total profits in the profit sharing ratio. Now, the second part of the question asks us to do what? To calculate the trading income assessment for each of the partners for all the relevant tax years. So, very well, we have to begin with the first year of trading of the business. The first year is for the Parker itself. So, let's do it for each of these partners in the year of assessment. So let's start off with Parker first. For Parker, what it is? This is the first year of trade, and thereafter we're going to follow the same set of questions. So this is the first year for Parker, second year, third year, fourth year for Parker. So let's begin without wasting any time. What do we have? Let's do it for Parker first. For Parker, what is it? The first year is 2011, 12. That is the opening year. Oops, sorry. Where have I written this? Right. So for Parker, what do I have? The first year is 2012, 2011, 12. Starts from the first date of the business, which is the 1st of January up till the 5th of April. So basically means how many months? 3 months profits out of the entire 80,000 profits given to us. So we are going to take 80,000 profits. Let me just show you the 80,000 profits as well. How much do we have? The first year 80,000 profits is there. Multiply this by 3 months out of the entire 12 months profit given to us. So 20,000 pounds gets taxed in the first year of business. What happens in next year, which is 12, 13, You make your timeline first and ask yourself a few set of questions. Is there a tax year ending this tax year? Is there a accounting period ending this tax year? Yes, there is. It is 12 months. Yes, it is 12 months. So what do? You tax those 12 months. So the entire 80,000 pounds gets taxed in the second year of business, resulting into an overlap profits of how much? Overlap profits of 20,000 gets taxed twice. 13, 14. You've already arrived at the current year basis. So just use the figures which you already have calculated here, which is equals to how much? Which is equals to the entire 117800. Come next year for 14, 15. Again, you're at the current year basis. Just use the figures which you have already calculated. So this is what happens for Parkers. Let's have a look at this. Now this last year, what happens basically? Last year, what happens? The profits, you're going to use the last year basis because the business has now ceased to trade. So profits are equals to how much? Is equals to 91,200. From this profit, you reduce, you less what? You less your overlap profits. Overlap profits of how much? Overlap profits of 20,000. Sorry. Resulting into a net profit of 71,200 is what gets taxed in the last year. So first year, what did you do? You did your opening year. This you arrived at your current year basis. Here you followed your current year basis. Here you followed your last year basis. Similarly, let's do this for the next partner, which is Pen. Now, Pen has started trading in which year? First year, this is not there. So, the first year when Pen has come in is 13, 14 is the first year of trading for Pen. So, what do? For Pen, 13, 14 is the last first year basis. You follow your opening year rules. You tax from the date of commencement of business, which is what? Which is the 1st of January up till the 1st, 5th of April. That is, you tax the first 3 months of profit. How much is the profit? This multiply by 3, divide by 12. Next year, what do you have? 14, 15. You now arrive at your current year basis. You ask yourself a few set of questions. Is there an accounting period end which ends this tax year? Yes, there is. How long it is? It is for 12 months. So you tax those 12 months. You've arrived at the current year basis. What do? You tax those 12 months, which is what? Which is the total 57,800, thus resulting into an overlap profits of 14,450 is your overlap profits. What happens next year? 15, 16. Let's have a look at, you've already arrived at your current year basis. So you're going to tax the entire profits of this year, which is what? Now this is the last year for Pen. So you're going to use your last year basis. 36,000 is what it was. Because this partner is now retired, you're going to now use the last year basis. Thus, you're going to reduce the amount of overlap profits. Thus, you reduce what? You reduce the amount of overlap profits, which comes out to be how much in net? Comes out to be 21,550 now gets taxed in the last year of pen, which is starting to trade. Now let's have a look at quill to start off with. First year starts trading in 13-14. Similarly, you follow your opening year rules. You ask yourself the 1st January up till the 1st, 5th of April. So you time apportion your first set of profits to what is the first set of profits for quill. Let's have a look at quill. This multiply by 3, divide by 12. Up next, what do? 14, 15, what happens? You ask yourself a few set of questions. Is there an accounting period end which ends this tax year? Yes, there is. Is it 12 months long? Yes, it is 12 months long. So you tax those 12 months as per your current year basis, thus resulting in a total profits of 57,800 being taxed, thus resulting into an overlap profits of 14,450. What happens in next tax year? 15, 16. You've already arrived at the current year basis. So what you do, just simply tax the 12 months of profits, which is equals to how much? Let's get it down, which is equals to 96,200 for quill. Up next, 16, 17. You have your last year basis. Last year basis. Why? Because the business has now ceased to trade. So out of the total profits of 88,800 in this year, what do? You reduce overlap profits, which is equals to 14,450, which results into a total taxable profits of how much? Taxable profits of 74,350 pounds for quill. So very simply, let's run through the question again. What we've done, we followed the opening year rules for every new partner, and we followed the last year rules when the partner retires or when the firm dissolves. So very simply, just keep your rules simple. Just know your laws, just know your rules simply, and you will be able to crack this very simple topic of partnerships. Let me get back to my rules now. What do I have here? Right. Now let's have a look at what happens when there is a trading loss relief for a partner, which basically means when you're giving away a loss relief for the partners. Remember, you had various reliefs which we had done in the previous session. So what happens for a trading loss relief? Where a partner has a loss for the tax year, he can choose to relieve his share of the loss in the way that best suits his individual circumstances. So you have a choice out of the various relief options that is available. Which of the particular set of relief would you like to avail when there is a trading loss relief for a partner? For an established business, option is between what? Option is between the section 64 relief against total income, without doubt section 261 relief, or the section 83 carry forward relief against future trading shares, of the trading profits. What happens when all partners of a new firm and a new partner of an existing firm may claim Section 72 relief for attributable shares of a loss of any of the first 4 tax years. So this is the opening year relief. Also, you can take a terminal loss relief. When a partner leaves a firm and has been allocated a loss prior to his retirement, he can claim the appropriate loss or form of loss relief, including Section 89, which is a terminal loss relief against his share of trading profits for the final year and the preceding 3 tax years of his trade. So basically, you can claim a terminal loss relief as well. If the partners as a whole ceases to trade, all partners can make a terminal loss claim. Why? Because the firm itself has now ceased to trade. So it's a terminal loss relief option available for all the partners of the firm. So very simply, whatever stage you're at, if it's an opening, it's a new partner, can also avail Section 72 opening year relief. If it's a old partner ceasing to trade business, that is upon retirement, you can take a terminal loss relief under Section 89. And if the entire business only ceases to trade, what do you take? You can also claim relief under Section 89. That is a terminal loss relief for each of the partners for which the partnership is now dissolving. Let's better understand this with the help of an example. What do we have? Example number 5. Flight and Bar trading on 1st of June 2012. Sharing profits and losses are 55% and 45%. Adjusted trading profits and losses are first year profit, second year loss, third year again profit. Calculate in respect of all the alternate reliefs available for the partners for the relief of each of the partners' share of loss. So what you need to do, you just need to very simply calculate the sharing profit and the loss sharing amongst each of these partners. So what do we have first? Allocation of allocations of profits or losses. We got two partners, we got Flight and we got Bar. 31st of two 2013. What do we have? What is the total? Let me just make a column for total as well here. The total is 16,800. Profit gets divided amongst the two partners in their profit sharing ratio, which is what? 55 and 45. So very simply just multiply these and divide them in their profit sharing ratio of 55% and 45%. What next? What about the next year, 31st of May 2014? What do we have up next? We now have a loss of 11,000 pounds. So there's a loss. Loss also gets divided amongst the two partners in their profit and loss sharing ratio, which is now 55% and 45%. Right? Up next, what do we have? 31st of May 2015. Again, there is a profit of 10,500. Let's bifurcate these amongst their profit sharing ratio, which is again 55% and 45%. Right? So what next do you have? Now let's have a look at assessment and losses of each of these partners individually in their trading income and how they can claim relief for each of these partners. So let's have a look at assessment of profits and losses. The first year being 12, 13. Let's have a look at for each of these partners individually. For flight, what happens basically? The first year is what? The first year is 12, 13. So 12, 13, you are at your actual year basis. You start from the 1st of June up till the 1st, 5th of April, which basically means a period of 10 months out of the 12 months which have been told. So you take out of this total income, you take only the 10 months of profits. Up next, what happens in the year 13, 14? You now ask yourself a few questions and arrive at your current year basis, that thereafter arriving at a total profits. Total profit is how much? Total profit here is the entire 9240 gets taxed here, resulting into an overlap profits of the entire 77,000 is the 77,700 is the overlap profits. What happens up next year? You've already arrived at your current year basis. So you tax the next 12 months, which is equals to, now instead of a profit, we have a loss here. Up next, what happens? In 15, 16, what you have? You already on your current year basis. So you tax the profits of these 12 months. Now remember, we've not ceased to trade business, so it's nice and easy. Let's do the similar calculation for bar as well. First year trading, what happens? It's 12, 13. First year is when? First year is from the 1st of June up till the 5th of April. We got 10 months out of the 12 months profit given to us. So what do you take out of this total 12 months profit? You only take the 10 months profit. What happens the next year? 13, 14, you now arrive at your current year basis by asking yourself a few set of questions, resulting into a total profit for the year ending 31st of May 2013 being taxed, resulting into an overlap profits of how much? 6,300. Up next, 14, 15, we have, what do we have? We have our current year basis, which is equals to, this year we've made a loss. Up next, 15, 16, we are already on our current year basis. We've made a profit of, the entire profit of 4,725 gets taxed here. Now that these are done, let's have a look at what are the options for relief for this loss that each of the partners have. For each of these partners, they have various orders available. Section 72 relief. Section 72 relief is what? Against total income of the 3 consecutive tax years on a FIFO basis, right? So because there's a loss in the opening years, because in the first 4 tax years, why? Because there is a loss in the opening years of business, that is in the first 4 tax years. So you have section 72 relief available. Also available section 64 relief, which is what? Which is against the total income of 14-15 as well as previous year. What is your previous year? Your previous year is 13-14 as well. So again, section 64, you have a relief available against the current year of the loss and the previous year, which is 13-14. Also, you have available a section 83 relief, which is what? Against own first available future trading profits of the same trade. That is what you have. You have available 15, 16 and thereafter. So against the first future profits of the same trade, you also have section 83 relief, which is available to you, which you can claim as a deduction in your for the losses that you have availed. Now let's get back to the rules. Now that we know what we can do with the reliefs, what sort of reliefs can be claimed, let's have a look at the rules for the capital allowances. So now capital allowances, assets attracting capital allowances may be owned by the firm or by the partners personally and used for business purposes. Where these are different arrangements exist, the capital allowances is calculated as normal, that is on both types of assets for the period of account of the business. Capital allowances on the firm's assets are deducted as a trading expense before the allocating profits between the partners. So even if it is for a private use, whatever be the amount of capital allowances, you reduce it before you start allocating profits amongst the partners. These capital allowances are attributable to the business use of privately owned assets, are deducted from the share of profits of each of the profits of partners after the allocation of profits. So what do? At the onset, you reduce the entire amount of capital allowances and any private use gets reduced thereafter. Let's have a look at example 6 and see how capital allowances comes in and basically gets calculated for capital allowances. So what do we have here? Smith and Jones are doctors in general practice. The practice owns all the assets attracting capital allowances, including the cars that are used privately by each doctor. For the year ended 31st of March 2016, the tax written down value for the asset is at the 31st of April 2015 is as follows. The 18% pool is given, car with CO2 emission 130 gram is given, Smith has a business use of 60%, Jones has a business use of 90% of the cars. So there is private use of both these cars. So you definitely need to do it on an item by item basis. On the 1st of October 2015, the firm acquired office or further office equipment costing £25,000 eligible for AIA. What else? Partnership adjusted profits before capital allowances were £228,000, £128,000, £500, and the profit sharing arrangement is as follows. Salaries is given to us and the profit sharing ratio has been told to us. So what we need to do first is we first need to calculate the working for our capital allowances. So let's first do the working for capital allowances. How do I do these workings? I start with my written down value as at that 1st of April 2015 is given to me. What all do I have? I have an 18% pool. I also have two cars. First, there is a car owned by Smith, which has what? Which has a 60% business use. So there is 60% use. And there is also another car owned by Jones, which has a 90% business use. Right? So I have these, and I am also going to prepare a column for my claim section as to how much am I claiming as capital allowances. So I begin with what? I begin with WDVs. WDV is what? WDV as the 18th of April is given to be, how much it is given to be? 65,000 pounds. Car is 24,000 pounds, and thereafter is 18,000 pounds. Up next, I'm going to always start off with the additions made. So these additions are eligible for capital allowances. So additions with AIA. In my 18% pool, I add my addition of 25,000 pounds. It is with AIA, so I give AIA. Always follow the same rules. Do not get confused. Very, very simple. Give AIA, claim AIA. Right? What next? Is there any asset with FIA? There is none. So what else do I have? I only have got WDV, WDA to provide WDA at 18% and restricted to the business use at 18% and business restricted to business use, which comes out to be how much? 65,000 multiplied by 18%. Similarly, I do what here? I do the same here for the cars. And when I'm claiming it, I now need to restrict for my 60% and my, so this gets restricted only to the business use, which is 60%, and this gets restricted only to the business use, which is 90%. Right? So how much capital allowances have I claimed in this year? AIA and WDA. Total of 42,208 is what I claimed, what I can claim as capital allowance. So let's get back to the main working. What is my adjusted profits given to me before capital allowances, which is equals to capital allowances given total is 228,500. Let's reduce capital allowances. How much capital allowance have I claimed? 42,208. Which comes out to be what? Which comes out to be now profits after capital allowances, which I first need to bifurcate amongst the two partners which I have, Smith and Jones. First I give away what? I always first give away salaries. Salaries are how much? Salaries are 50 and 50 for both the partners. Total is there any interest on capital given in the question? There is none. So the remaining can be divided in the profit sharing ratio. How much is remaining? Remaining is 86,292. Gets divided, profit sharing ratio is 2/3. So this multiply by 2, divide by 3. Similarly, for my second partner, which is, what have I done? little incorrect here. This is equals to this multiply by 1 divide by 3 here. So this is what the total income profits under assessment comes out to be 107,528 for Smith and 78,764 for the second partner. Very simply what I have done when I am given capital allowances in such a question, I first calculate the capital allowances claim for the entire firm. Thereafter, I reduce from the total profits the amount of capital allowances. This is profit left to be bifurcated in the profit sharing ratio. First as salaries, second as interest on capital if it was given in the question, and the remaining as in the profit sharing ratio given in the question. What else? Let's quickly get back to the rules without wasting any time. What happens if there is a limited liability partnership that we have been given? If it's a limited liability partnership, what we need to do is that the LLPs are separate legal entities in which the partner's liability for the firm's debt is limited to their fixed capital. Why? Because these are limited liability partnership. So what happens basically, the liability is limited to whatever ratio has been defined above. Each partner is thereafter taxed on his share of the LLP profits, applying the rules which we have already discussed. So the same rules follow which are going to be there for the partners as well. So very simply what we've done today is that for the partners, we've been able to bifurcate. Let me just open up another blank page. Right. So what do we have? Let me just reduce the thickness a little bit. Right. So today what we did unincorporated traders rules for partnership firms. What happens basically? Partnership firms, we need to define the partners. That supposedly there are 3 partners. We divide the profits, the salaries, the interest on capital in the profit sharing ratio. First in line gets the salaries, thereafter give away interest on capital, and thereafter you give away your profits in the profit sharing ratio. If it's a new firm, it's a new partner that has come in, what do you do for new partners? New partner that joins a business, you apply the opening year rules for the new partners. Any partner which retires from the business, you follow the last year rules for them, thereafter providing relief for overlap profits. Also in case of losses, you can claim relief depending upon what period of business are we at. Can we give opening year relief? Can we give relief against total income? Can we give relief against total future profits from the same trade? Can we give relief against chargeable gains? If it's a business ceasing to trade or the partner relieving, can we give a terminal loss relief as well? So all the options which were already available to us will also be available to us right now. Also, when we've been given capital allowances, what you need to do? Your adjusted profits gets reduced by the amount of capital allowances, and thereafter the remaining gets divided in the profit sharing arrangement. So then thereafter give away your salaries, interest on capital, give away your profits in the profit sharing ratio. So very simple rules for partnerships. Do not confuse yourself. Just follow methodologically what needs to be done for opening and retiring partners. If the business is ceasing to trade, what do we do if there is a loss in a partnership? So very simply, we have the same set of rules for us, right? Now that we've finished it, let's have a look at what we basically going to do in the next session. We are going to look at the employment or the self-employment rules. We're going to look at the rules for employment and self-employment rules. Also, we are going to look at another basis of small businesses, which is known as the cash basis for small businesses. Till then, revise what we've done in the class today. Make sure you're doing lots of question practice at home. Make sure you're doing the questions that we have done today in the class as well. Absolutely any queries you have regarding today's session, you can always email it to me at Shilpi acca@gmail.com. That's it then. Thank you very much for today's session. Thank you.